Currently, the Nigerian stock market is capped at 160 trillion naira. Yes, 160 trillion naira. Now, do you know there are some investors that have benefited immensely from this growth? Now, they don't just pick individual stocks, but their investment is giving them a direct profit as the NGS grows, their stock market, their investment also grows. Now, welcome to Clockwise. This is where we give you the latest news when it comes to investing in the stock market. Now, we tell you every reason behind every bullish and every bearish movement. My name is Providence, and like I do it often, I came with my guest. Now, my guest is someone that does so well with analysis, and also he sleeps on the charts and he sleeps on the fundamental of these businesses. Now, with the resounding virtual round of applause, welcome, Mr. Kane. Welcome again to Clockwise.
Thank you very much. Thank you very much.
Now, today we'll be discussing the NGX. Most people don't understand that the NGX actually has a direct proportion to some investments. As the NGX grows, and it's going to grow more, we are at 160 trillion now. What means that as they grow, even as Dangote is about listing, it will also grow more. Now, these persons in their investment will actually also grow. But before then, what do you think is responsible for this, should I say, a geometric growth in the Nigerian stock market?
Thank you very much. So, the NGX, short form for Nigerian Exchange Group, is the Nigerian stock market. And so it is a collection of, stocks that sell, especially for Nigerian companies.
Okay.
That's where we can buy and sell equities, securities, especially equities of the Nigerian companies. So we have seen an explosion in the NGX.
So much.
We are already up over 61.7% year to date. That's if you had invested in an ETF, for example, that tracks the NGX, you should be up somewhere in the neighborhood of 60%. And then that has been because of four reasons. Number one, the post-FX reforms. So if you remember 3 years ago, when the FX liquidity was extremely low. And so what happened was that the Nigerian stock market was almost a death trap, especially in investment terms. Meaning
people were avoiding it.
People were avoiding it because you come into the market, people that had their investment in Nigerian companies were unable to repatriate. Because for you to repatriate, you need to cash out, change it into US dollars, and repatriate it to your country. Now, with the FX, the very, very tight FX liquidity, it made it almost impossible for you to do that repatriation.
Okay.
And especially for foreign portfolio investors, FPIs, they only want to go into markets where they can actually move their capital around.
Okay.
These guys that hunt for performance, so they can't afford to have their funds stuck in a particular economy. But we've seen a very serious reform in that regard that has made access to FX to be stable, and now you can even see the stability. Then the exchange rate has sat around 1,300 and something for a long time.
Very long time. Yeah.
So that predictability,
unlike before, that was totally
I told you, it was on this podcast that I told you of it. I just literally bought 1,260. Before I could do the next buy, I was doing a 1,330. The very next buy, which was the same, like just about 30 minutes apart. So we've seen that stability now, and that stability means the market, it becomes more predictable to investors. Now, there's something we call absolute return. So, for example, if you invest, let me give you something to think about. If you invest in Nigeria and then you do 100% of your investment, but within that time, that investment period, naira has depreciated by 50%. That means you have not made any money. In absolute terms, your foreign purchase power is actually zero. Has not improved at all. So, but when you have a predictable foreign FX regime, then you can actually invest and know exactly. And by the way, remember, for every investment, there is something they call investment premium. When you want to invest, especially in countries with political and macroeconomic risks, you want to protect yourself against risk, and that is you have to pay premiums. So for countries like Nigeria at that time, where repatriation of funds was difficult and all of those things, inflation was galloping, the investors were charged more by insurance companies, for the investment
liquidity.
This is how you think about it. How much am I paying in insurance premium? What is the expected returns? Even if the expected returns is 50% and I'm paying 20-25% in insurance premium, it doesn't make sense. Because at the end of the day, you look at absolute return, because all of these things are considered what we call opportunity cost. If I have $100,000 and I'm choosing to invest in a particular economy, that precludes investment of the same amount in another economy. So I have to put things together. So one of the things is FX liquidity was threatened. Then the next reason why the NGX has been performing very well is because of the banking recapitalization.
Okay.
So that gives that confidence to international investors that the banks are strong. The reality is that if there is what we call canary in the coal mine, the banks are actually what we call the canary in the coal mine. If there is going to be any economic shakeup, it starts with the bank. So if the banks are capitalized, then investors have that confidence that at the end of the day, if anything happens, the banks are able to really provide that backstop. Now, beyond that, you know that banks, when this recapitalization allows banks to have more to be able to loan out. So their interest income, you've seen, I mean, we saw for the FOGAS, the report, the Q1 2026, interest income was through the roof. Even non-interest income also went through the roof too. So recapitalization is something that has strengthened the market. Then the next is inflation. Inflation has moderated. When inflation moderates, it also has a way of attracting international investors. Before now, so international investors are able to come into Nigeria and then invest, knowing that, because at the end of the day, you look at your returns minus inflation. Because if you're investing in Nigeria, you have to convert that money into Nigerian naira and invest. So you look at what the return is minus inflation. That gives you your absolute return. Of course, sometimes minus the insurance. We have talked about insurance premium and all of those things. It gives you your absolute return. So if inflation is high, then that means you need your investment to be extremely high for you to make a decent margin in terms of your profit. So that has also been another reason. So with the moderation of inflation, it has also happened. Then the last one has been some of the reforms in terms of the pension and all of those. If you observe, Nigeria's sovereign wealth funds, pension funds, even institutional investors within the country, before now, they avoided the Nigerian stock market, the Nigerian capital market itself. So now you have, the pension fund managers are able to invest in Nigerian securities in terms of equities, bonds, and all of that. And now, if you also look at this, I think at the last podcast or so, we talked about the fact that that PENCOM has now allowed Nigerian pension fund managers to invest in the Dangote refinery. So that these inflow are reasons why the NGX has performed very well.
We've actually seen the reasons why we are having this growth. So it's not just assumption. It's not something that is not vague. There are structures that are propelling the growth of the Nigerian stock market. Now let's shift to those ETFs that are actually tracking it. You see, the ETFs are tracking this growth, and should I say it's a direct proportional relationship between how the market fares and how this particular ETF also grow. And investors actually making money as the entire stock market is growing. So let's look at this ETF and let's look at the relationship between the ETFs and the stock market.
Okay, so I'm going to mention two ETFs. I'm going to pull up the chart. So the stock market, like I said, the all-share index is actually a benchmark, but you cannot buy the all-share index. Actually, you can only buy ETFs that tracks, that. So we have, and how does this work? The Nigerian exchange, the NGX, the all share index actually is actually mega cap weighted, meaning that bigger companies contribute more or influence the performance of the NGX more. And so what that means is that there are different strategies that you can try to track the NGX. One of which is a pull of a new gold ETF. If you look at the chart, you realize that it's close to the. Remember, we have about 130 companies.
Registered?
No, companies, more than 130 companies that trade on the Nigerian stock market. And so a way of doing this is the top 50 companies. Some index track the top 40, some top 30, like Vetiva, like we are going to talk about Griffin. We've talked about it before, but it tracks top 30. And while the chart might not be the exact replica of the all share index, but you realize that it is close. Okay. And why is it is close is because the top 30 companies in Nigeria actually influence the total returns on the all share index way more, because the index is actually market cap weighted. We don't have in Nigeria, we don't have such a matured. When I mean matured, it's not as matured as what we see in the developed countries, where we have the mega cap weighted S&P 500, and we have the equal weighted S&P 500, which may, and they operate differently, because in the mega cap weighted, the bigger companies, the Nvidias, the Alphabets, they influence the index more, but the equal weighted is like 0.25, or it's the same investment that you make across all the companies. You don't even consider which is bigger and which is not. Okay. So that's why one of the strategies I'm going to mention here would also mirror that kind of strategy. Okay. So you can either invest in like Vetiva, Griffin, 30
companies.
Yes, so that one is top 30 companies. Like I said, we have over 130 companies that are listed in the stock market. So your guess is as good as mine that it's not going to be a replica of the entire market. Whereas the all share index is most of the listed stocks is actually captured in the all share index. It actually tracks to some extent, because these are the biggest companies that contribute most to the index, the return on the index. So that's what. Then there's also the new gold.
Okay.
Vetiva and new gold index. New gold index also tracks that too. It tracks the
how many companies?
It tracks the it's even closer to the NGX than Vetiva to some extent, because Vetiva is just 30 companies. This one has exposure to more companies. So that is one strategy. That's one strategy, investing in these ETFs, those two ETFs I just mentioned.
Vetiva and New Gold.
Yes. The second strategy is, and I'm going to tell you what I'm doing. So the second strategy is you can invest in mutual funds. Some mutual funds, especially, we have two mutual funds, two types. We have the equity, and then we have the bond
market,
the bond fund, bond mutual fund. So we have the fixed income mutual funds, and we have the equity mutual fund. So the equity mutual funds actually also track, because what they do is that they invest across these companies.
Okay.
In the weight of these companies, in terms of they invest more in companies that influence the market more. For example, we know that the behemoths include like Dangote Cement, Bua Cement, Seplat, and those are the tier 1 banks. Those are the biggest contributors to the all share index. And so they invest more in this. Then the mutual fund invests more in the same ratio, in the percentage which these stocks contribute to the all share index. So that is why you see, to some extent, the mutual funds will perform well. When the all share index performs well, they also perform well too. So they might not return as much as, like I told you, they closely track. We don't have, in the US, for example, you have funds that literally track I'm telling you directly. Okay. We have like the Vanguard Total Stock Market Index. If the US stock market did 20%, that particular index would do, ETF would do 20%.
Okay.
So, but we don't have something like that in Nigeria.
So we have something that is close.
Is that have something that is close. Then another strategy, which is a bit more manual, but it's more accurate, is you can actually create what we call a mini fund. That's what I do. A mini fund means that you can actually literally invest in these companies. One of the things we plan to do on this channel would be that. So we invest in this company. So if let's say that I'm just giving an example. Let's say that Dangote Cement is like, let's say 10% of the stock market. So if we are investing, we're going to do like 10% of the market, like 10% of our investment will go into Dangote. The refinery is coming in. We are estimating 43% of that is going to be 43% of the Nigerian stock market. So what do? We invest 43% of make 40% of our investment into that. So you will realize that fund would track the Nigerian stock market very closely.
Okay.
That one, it needs there's some work to be done, because the market cap of these companies is not constant. It fluctuates. So as it fluctuates, you have to do what? You have to modify your investment. That's why we talked about sometimes you have to rotate from one into another, because the stock market, you are literally trying to ensure that you match your mini fund matches the contribution, the relative contribution, the relative component of the all-share index.
Okay.
Yeah. So if you do like the top 40, top 50 companies, that would, because if you look at it, over 90% of the index, of the all-share index, is contributed by the top 50 companies.
Okay.
So you are going to be very, very close, almost mirroring the all-share index.
Let's go through it again, so we'll get what we're
So number one, we're saying you can invest in Vetiver Griffin 30 or New Gold. Those are ETFs.
Yes. Okay.
You can invest in mutual funds, like
Stanbic
IBTC Mutual, Ameritrade, and the rest. We have mentioned that on the previous video. You can go back and check that video. Then you can also do your own mini
investment.
in ETF, actually,
ETF, right.
where you actually physically allocate to these companies in the ratio that they contribute to the all-share index.
That means that as the NGX actually growing, you'll be growing.
You'll be growing almost
simultaneously
in the same.
All right, now we can actually take away the part of risks when it comes to these investments, especially the Nigerian stock market. You cannot accurately predict what will actually go on. So let's look at the risk part of it.
So I'm going to start from something that is very obvious. One of the challenges with investing in Nigeria, and I'm saying this because I've invested in Nigeria, I've invested in the US stock market, I've invested in a couple of other markets, Asian markets and all of that. The challenge with Nigeria is that the depth of market is still very shallow.
It's not as large.
It's not as large.
You don't blame the country. We are still growing.
Well, okay, so it's been better over the past year or so.
It's been better, yeah.
It's been remarkable. And of course, we have talked about the reason why it's been remarkable, but the depth of market is still very shallow. What that means is we see a lot of Hotel California situations in the Nigerian stock market.
There are stocks you buy.
Liquidity
is very difficult.
And because of low liquidity, you are unable to exit. So,
but I think the stocks we talk about here, we don't have liquidity.
Yes, but you are not. The stock we talk about is not. I'm talking about the entire market.
Yes.
Entire market. We've had Hotel California situation in the Nigerian stock market. The second thing is concentration risk. If you look at
explain that Hotel California, so people can actually understand.
Okay, Hotel California. Okay, so here is the deal. Hotel California, what I mean by Hotel California is actually it's an investment term. It's a term used by investors, which means you can easily get into a particular position or buy an asset. You cannot sell. You cannot exit. So it's actually the song by the Beatles where it talks about you can check out. The song is titled Hotel California. It said you can check out at any time, but you can never leave. So that is one of the situations we have.
Yes.
I had told you of a friend of mine that has been trying to exit a particular position, a company stock, but it's not able to do that. So that's number one. Number two, like I said, concentration risk. Concentration risk for me is very big because, and even this Dangote listing is going to make it even more glaring. When a particular stock constitute 43% of the total stock market, that's a very big risk factor. You might not understand, but I remember when I talked to you guys about taking profits, one of the things I said is you want to reduce concentration risk as an investor. Because when your portfolio is skewed to one stock or just a group of stock, anything that happens there can actually dip your portfolio terribly. Now, the same thing with the Nigerian stock market. I want to let you know that this, if you look at it closely, the All Share Index has been moving high because of the performance of Dangote Cement, Boa Cement, MTN, ATL Africa, and then you have the financials like the Tier 1 banks. These small group have literally been the one that have been piloting the entire market. If we had an equal weighted index, you would understand that the market is still very low. If we had an equal weighted index, Nigerian stock market will either be marginally positive or even in the negative region. Because you have more companies that have not performed. Do you know that as we speak to you now, that UBA and Access Bank, for instance, are like less than 5% year to date, between 5 to less than 10% year to date.
Performed so greatly.
So, but you like the likes of GTCO, the likes of Zenith Bank have outperformed.
All of them.
And okay, so you realize that's a concentration risk, really. When you have a very small group of companies or stocks driving the growth, that's a concentration risk. And that means that if anything happens to those particular stocks, you can see your investment or your portfolio dip by double digits. Okay. So that is another thing. That's another risk. The other risk that we cannot ignore is political instability. This is election year. Nigeria has a challenge, unfortunately, and I'm saying this because, we have to tell ourselves the truth, and you need to have the right information to make your investment decision. I'm a Nigerian, but I'm going to tell you that the political situation in Nigeria is political inconsistency makes such that if the government is driving in a particular direction,
there's a change in government.
You see, we take like 5 steps backwards. And so investors are not traders. Investors plan over long term, and they need some kind of political stability to be able to do their math.
But I feel the current, policies will actually safeguard the market for some time.
What is that sometime? What is the length of that sometime?
That's what we cannot actually predict.
So that's what I'm saying. If we had something like in advanced country, you have what we call a national development plan. So what that means is that it's a framework where subsequent administration will not just come in and come up with something different. Yes. So that if investors can have that confidence to invest in a particular asset for a long time and not invest and then every morning they look at their charts. You want to invest over a period. Patient capital is what drives performance in the market. Okay. So we have to, if we can have political stability, if we have FX stability, if inflation is tamed, if we have a more diversified stock market, and then if our GDP, our market cap to GDP, a lot of people are still outside the market. That's why our market cap to GDP is still around 35%, which is very poor. So, but if we have more people, I'm happy with what Dangote is doing, allowing the ordinary Nigerian to actually invest. Yes, to invest in the stock market. That allows more people to participate in the market, and then you have a more stronger.
I believe we are still growing, and the market is still a good place to actually invest, no matter how we've seen it, because there are still downsides.
There are still opportunities,
but the upsides are still okay. The Tier 1 banks, those the bourgeoisies, the big boys,
the
fugas of the Nigerian, they are doing well to ensure that they accommodate whatever changes or whatever shock that is coming up. So we can still give it to them. They are trying. Dangote is also doing very, very well. His listing of the refinery will actually do a lot in the market.
We'll
And
push the stock
so we
market.
can still invest in the
index.
market. The market is still okay, but we will still tell you the other side of it, so that you can actually make your decision. That's why you have to be on this channel. You have to subscribe to this channel. So we'll tell you these things as it is without actually painting it. I think we should end it today at this point. Thank you for coming. Thank you for coming. Thank you for coming. Now, we've gotten two form of, should I say, messages where people have two different issues, and we'll be treating those issues. First, people want to learn how to trade in the stock market, how they want to participate, how they'll participate in the stock market. The other set of persons want to trade or want to invest real time as we're investing, because we are tracking this investment real time. So there will be a link at the comment section. You just click through the link, and you'll be taken straight to the group. And on that group, we'll differentiate what you want. You want to learn stock, investing in the stock market, or you want to trade with us, or you want to invest with us at the same time we're investing. So there'll be a link at the comment section. You click through that link, and you actually communicate with us directly. Now, on that note, we'll come to the end of today's episode of Clockwise. Do not forget to like, subscribe, share, and also put a notification bell on this channel. And also do not forget that the illiterate of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence. I'll see you again. Please do not forget to click the link. See you again.